Hey, welcome back. Today we're going to talk about how to structure a joint venture real estate deal. Are you looking at getting into a joint venture deal, but you're not sure how to structure it effectively? In today's video, we're going to cover that. We're going to show you exactly what you need to look for, how to find your ideal joint venture partners, how to structure it like a pro so you're setting everybody up for a win-win scenario. So step number one to setting up an effective joint venture deal is to find your ideal joint venture partner. Just makes sense, right? So typically, if you're the active real estate investor, you're going to be bringing the deal and the team and the experience to the table, and you're going to be looking for someone who can come on board, typically with capital and perhaps even with their credit. So you want to make sure that you're finding the kind of person that's the right fit for you, the kind of person that shares your same values, your same goals when it comes to investing, and who has the funds and or the credit available to make the whole deal happen. So you want to find that ideal person. And when you're first getting started with raising capital, I'm going to suggest that you really focus on your inner circle, your friends, your family members, your coworkers, business associates, people that you have a pre-existing relationship with. Why? Because they already know you, they already like you, and to a certain degree, they already trust you. Now it's just a matter of showing them what's in it for them for investing their capital with you in a deal that you're going to partner in on together. You only make money if they make money, and you're both able to get ahead through doing a partnership, a joint venture like this. Next thing you want to do is you want to determine the purpose and the scope of the joint venture partnership itself. And just as importantly for you, even more importantly for your joint venture partner. So you got to have a really good idea of obviously what kind of property you're going to be getting into, the market area, what your strategy is, what your exit strategy is, what the goal of this deal is. Is it a short-term goal in and out fairly quickly, or is it a much longer term play? You want to make sure that you and your investor partner are both on the same page and that you can show them the deal succinctly in a way that's easy for them to understand and get their head around. Next thing is you want to determine and define the contribution of each joint venture partner. So in the example we talked about before, we were talking about you being the active partner, bringing the deal to the table, bringing the team to the table, bringing the expertise to the table, the management to the table, your joint venture partner coming on board with capital and or credit for financing. But there's all sorts of different ways that you can structure joint ventures. In some cases, it might be one partner brings the deal to the table, another partner is responsible for the renovation side of things, another partner is responsible for investors, investor relations, that sort of thing. So that's a different kind of situation, in which case you want to make sure that you've got a very clear understanding of who's responsible for what and who's doing what. All right, once you got that figured out, the next step is to take it to a lawyer and get your joint venture agreement put together. And in this agreement, it's going to very, very clearly outline the responsibilities and the rights of each partner, what's expected from whom, what the profit distribution is going to be, what the ownership distribution is going to be of that deal, what the responsibilities, what the risk, what the rewards are, and what the dispute resolution system is. What if somebody needs to get out of the deal sooner than the anticipated exit? How is that going to be taken into account? So these are all really important things that you need to kind of have an idea of before you even get to the lawyer. But if you don't have all of that dialed in, then ideally you're working with a really experienced real estate focused lawyer who can point things out to you, who's had experience doing these kind of agreements and who can fill in the gaps with things that you might be missing. Now, depending on the kind of deal and the size of deal that you're doing, these could run from anywhere from $500, $1,000 for smaller, more simple type joint venture agreements, all the way up into tens of thousands of dollars for much larger deals. So for example, when I was doing joint ventures with single family homes with one joint venture partner per deal, pretty simple, pretty straightforward. The first joint venture agreement I think cost me $1,000 or $1,500, but after that I was able to basically rinse and repeat that same agreement for deals moving ahead, and I just had to pay for basic legal expenses there. On the other hand, once I got into bigger deals doing multifamily properties, I remember one deal that we worked on. It was myself, my partner as the active partners, and we had, I believe, 5 investor partners on board. So there's 7 of us all together in this deal. Well, that agreement I believe, if I'm not mistaken, cost us $17,000 to get put together, just because there were so many different moving pieces there. But we had and by the time, not only that, but by the time all of our investor partners had their lawyers look at it and their lawyers poked around a little bit in there, it was a very, very robust, very tight agreement, but it wasn't cheap. So you have to keep that in mind as well. All right, once you've got the joint venture up and going, then you need to manage it. You want to make sure that you've got regular reporting, regular meeting with all of the partners. So depending on what you're doing, I would suggest that you're a little bit front end loaded on this, especially if you're working with newer joint venture partners who haven't got much experience investing in real estate, or they don't have much experience working with you. Then I would suggest that at the beginning of the relationship, you meet more often than you might want to later on. So for example, when things are up and getting going, you might want to meet with people and give people a heads up on what's happening on a quarterly basis every 3 months. Then after the first year that you're involved, maybe you cut back to meeting once every 6 months. And then after that, perhaps it's once a year. And then you just make sure that you keep everything open for good, clear lines of communication with people when they want to find out something. Make sure that you're super responsive. This is really important because it's not about doing just the deal today, just this particular joint venture. But if your joint venture partners are happy, then they're going to do more deals with you moving down the line. They're going to refer you to their friends and their associates who also have capital, and you can do more deals that way. So you want to make sure that you keep your investor partners happy. One of the biggest mistakes I see people make is they get the deal up and going, and then they kind of forget about their investors, unless something big happens, or unless they get nagged and they finally agree to meet with somebody and show them what's happening. You want to be proactive about this. Make sure that you're Johnny on the spot, showing people exactly what's going on, the good and the bad, and keeping those communication lines open. All right, if you like the idea of structuring joint ventures, then you're going to need joint venture partners. If you need joint venture partners, I've got the perfect resource for you. It's my book, Money Partner Formula. It's all about a proven formula for attracting your ideal money partners, your ideal joint venture partners. Who they are, where they are, how to approach them, how to create curiosity and get them coming to you. This is a proven way of raising 6 figures very quickly in a matter of weeks, and even 7 figures in a matter of months, so you can really scale things up with your portfolio. Go ahead, grab your free copy today, investorattractionbook.com, or click on the link in the description below.